This is GYC's third quarter perspectives. The recent sell-off that we experienced over the last couple of weeks has brought stocks into a correction phase. But even despite this, we can see that the performance difference between stocks and bonds year to date is still quite large. And with momentum still being strong, that's why we are still positive on stocks, still performing well up to the end of the year and even beyond. There's a lot of positive backdrop to this, and I'll go into more details. What we are heading into is typically what we call a seasonally weak period for markets. You can see here August and September represent usually the weakest months of the year for stocks. And we should expect stocks to be trending sideways at least for the next few weeks or so. And it usually sets up for a good fourth quarter in terms of returns. Fears of recession are actually unfounded. I think a lot of fears rose over the last couple of weeks after the sell-off. But you can see here the data actually points to low recession risk. And as long as we are in a low recession risk mode, we can be confident that the economy is not going to be slowing down more than expected. And this represents a good opportunity for stocks to continue doing well. The election cycle also represents a good opportunity for a year-end rally as stocks tend to strengthen into the fourth quarter as the incumbents or the opponents become known and their policies become a little bit more clearer. In terms of risk indicators, when we look at whether there's stress in the financial system or even looking at rally and bull market indicators, it still points to this current period of uncertainty as a sell-off rather than a bear market. Finally, the Fed is expected to cut rates sometime in September, and a rate cut void of recession is usually positive for stocks up to 12 months from the date of the first rate cut. And when we look at sector performance year to date, you can see that technology sector has come down quite significantly following the recent sell-off, more in line with the rest of the other global sectors. I think this just points to the simple fact that diversification works. If you're overweight in one area or another, you may experience an unusually large sell-off more than expected. Okay, so this is why one of the tenets of our portfolio management is that we should be diversified broadly such that we get a blend of all sectors and performance.